4, 3, 2, 1. Hello, everybody, and welcome to another Capital Gains Tax Solutions Mastermind, also streaming expert CRE secrets, where every single Friday we're diving into the top questions, ultra high net worth individuals who are selling multi-million-dollar assets should be considering as it pertains to their exit planning, capital gains tax planning, estate planning, as well as estate tax. And so we are talking today to kick us off 7 reasons family offices should consider using the DST for their exit plan, or the use of the DST for their exit plan. For those that don't know me, my name is Brett Swarts, founder of Capital Gains Tax Solutions, and I'm coming fresh off of speaking at the Family Office Capital Raising Titan event in Fort Lauderdale, Florida, where I've had a chance to glean wisdom from some amazing speakers as it pertains to raising capital, investing in businesses and real estate. And I was able to speak on stage, which is so great. And so part of this talk will be on basically what we talked about, and also giving you some real practical reasons, especially if you're facing estate tax. I think that's such a big thing to understand. And so let's talk about the first reason, if you're in a family office, you should consider the DST for your estate plan, is the problem of estate tax, known as the death tax. You may have a living trust that has to do with passing your assets via outside of probate to your heirs, but you may not have something that's solved your estate tax, which if you have a net worth of 24 million married, and or about 12 to 14 million single, you're looking at a huge estate tax of 40%, which the stepped up basis does not solve for. And so number one reason that you should consider the use of the deferred sales trust for your estate plan has to do with eliminating the estate tax. Let's talk about the number 2 reason you might consider using the deferred sales trust for your estate plan. That has to do with just the continuity of transferring wealth to the next generation in a seamless way, not just eliminating the estate tax or eliminating the capital gains tax, but actually as it pertains to continuity, meaning having it set up prior to. So a lot of people own multiple multifamily properties or commercial real estate or businesses. These assets are very active, hands-on assets that a lot of our clients, before they find us, are thinking they have to stay in. They have to continue to manage the properties. They have to continue to manage the business because of holding on to the stepped up basis, right? Stepped up basis upon death. And so they feel trapped between a rock and a hard place, which is, hey, I want to retire and I want it to be seamless for my kids, but 1 or 2 of the kids may want to retire or may want to run the business. They may not want to run the business. They may want to retire on all the wealth that I give to them, right? So this is a lot of moving parts there, where if you can sell the asset today, then set up an estate plan that is predictable and that is a certain amount per year for kids, this become a seamless way to build wealth. Also, which leads us to number 3, which is maintaining the legacy of the wealth. A lot of our clients want the ability to invest back into real estate or businesses or with their kids, or give their kids the opportunity to do that. And so the legacy of how you've built the wealth, you want to know that the funds in the trust can go into other investments with your children. And so, for example, we helped a client. They sold a multi-million-dollar property in Colorado. They lived in California, and they moved the funds into the Deferred Sales Trust Plus to eliminate that 40% death tax, but also to simplify their investments. They put into mostly liquid investments, and they're waiting for the market to shift into a more buy-side friendly real estate environment. So they use the DST Plus to solve those challenges, and also give their kids, who at a future date probably are going to want to be active in real estate, because guess what? Mom and dad made all their money in real estate. Mom and dad don't want to manage it anymore. And so the deferred sales trust gives the ability to for them to retire, but then the kids to be active again. And so if the legacy is, hey, look, kids, I want you to be entrepreneurial. I want you to buy the business, buy the real estate, own and manage. When you're ready for that, we don't want to do it now during our retirement years. But if the trust can do that at a future date, that can maintain the legacy of building that let's say that cash flow real estate wealth, or whatever wealth that might be for businesses or investing in other things. And so that's a powerful way to use the DST. That's the number 3 reason to pass the legacy. Let's talk about the number 4 reason. The number 4 reason would be, I think, just security, right? The ability to diversify your wealth right now and to be out of debt and to preserve what you've built for the family legacy, and the flexibility of diversification is so, so important. In other words, you can pay off debt. You can get out of maybe some highly appreciated assets that have a lot more liability with either debt and or states in which are maybe not as friendly for the business part of it. And so to be able to do that can preserve the overall estate and where you're at. I think the next couple, the last 2 would be, I think, partnering. A lot of family offices we work with, they're looking for ways to partner with the trust. And not only with them, with their own family or own members, but with other family offices, right? That might have other investments to go into that are more favorable. And so if you're a family office who wants to have an estate plan and investment strategy that has multiple partners, then you want to consider using the deferred sales trust for that plan, which leads into the last one. And I think that has to do with making an impact. If you have more money and less risk on the first top 6 reasons, that impact can make all of the difference for either giving to charity, to making sure you're holding those charities accountable, or your heirs are with the funds in the trust, and to be able to be adjusting. In other words, not having to give it irrevocably all the way to charity. You can still have the funds go to charity, but you have the ability to hold accountable the charities that you believe in, the reason you invested into. In other words, leadership can change, things can change, and the things that mom and dad thought they were giving to might change over the years. And so what better way to maintain that legacy of impact by having options to adjust? What we learned during COVID, and even during right now, what's happening is you want a team and a strategy that has the ability to pivot and to change with changing circumstances. And so the Deferred Sales Trust Plus is an amazing way to do that for your estate plan, while providing a lot of opportunity for you and your family to create and preserve wealth and make an impact. If you want to learn more, you can go to capitalgainstaxstrategies.com. That being said, we're going to open it up for some of our folks who are joining us today. In fact, we do see one of our strategic alliances, Rebecca Munson, out of Lake Tahoe, Truckee area, real estate professional expert up there. Rebecca, what is going on in the beautiful Lake Tahoe, Truckee area?
Oh gosh. Well, summer is in full swing up here in the Lake Tahoe, Truckee area. It's incredible. Real estate market is still moving. Yeah, things are good. It's great time of year to be up here.
And what would you say the temperature is of the real estate market itself as it pertains to people buying and selling real estate, interest rates that are definitely still a challenge for folks? What are you seeing as far as inventory? What's kind of the temperature of values in real estate right now?
So inventory is definitely up compared to the last 2 years since, mid 2020. But we're seeing it shift more to a more typical real estate environment. So homes are staying on the market longer in general, but homes are still selling. So we're seeing buyers at all different price points, from your $500,000 condo to your $15-20 million lakefront home. So inventory is still moving. If it's priced right, it's selling. Things are selling for probably, I want to say, 5% to 8% below asking price, but things are still selling. So
now let's dive right into someone who might be listening to this and saying, wow, I got a big house on the lake. I want to sell it for 20-25 million. I've owned it for 5, 10, 20, 30 years. I have a huge gain. Let's just say it's on the California side of the lake, right? Walk them through what the Deferred Sales Trust can do as it pertains to helping them have more wealth at closing versus less with tax.
Well, obviously in California, there's not only there's the capital gains tax, right? Even though, you know, if they're married, they only have the $500,000 exemption. But if it's 20, 25 million, the deferred sales trust, the DST plus is probably going to be the best option for them. If they have, you know, more than 15,000 or $15 million in debt, then we may need to look at just maybe a typical DST, but it saves them so much in taxes. It's just incredible. I mean,
Spot
we're
on. Yeah. So
talking
it's 33% is the
35
minimum.
to
Yeah.
45%, depending
Yeah. So
upon.
33 would be the minimum, right? If it was primary home. If it were an investment property, you're looking at 37 is the minimum. And then if there's depreciation or capture, I can go higher, you know, let's say 40%.
Yeah.
And then it would be the key of be what's the basis,
Right.
what's the debt, what's the sales price, right? Now, we're going to take the, you know, say 25 million. Let's imagine 5 million was the basis. So that's a $20 million gain. So 20 million by, let's say it's a primary home, 33%, that's about $6.5 million of tax. And so the question is, do they want to pay the $6.5 million of tax? Probably not, right? Number two, do they want to sell? Yes. Number three, have they been reluctant to sell because of the tax? Maybe, maybe not, but let's imagine they are. Guess what? The deferred sales trust is that solution to all of those challenges, because you can now sell, you can defer the tax, and then you can put it into cash flow investments such as Rebecca. What kind of investments can you put it into?
Pretty much anything you can think of, you can put it into. I mean, you can put it into, you know, additional real estate if you want to. You can put it into stocks, bonds, cryptocurrency, pretty much any investment tool that you can think of. But it depends on what your risk tolerance is. And we work with financial advisors to make sure that it meets your financial goals. So.
Perfect. Now, what about someone like yourself, Rebecca, where you and your husband are building houses, custom homes over all the years, right?
Right.
And you're wanting to be business and entrepreneur with the money. Talk about how the trust can partner with you and invest and help you guys build your business versus having to get a loan from a bank, which, gosh, it's twice the interest rate that it used to be right a year ago. So talk about that.
Yeah. So, yeah, you can borrow or partner with the trust. I guess is a better word rather than borrowing. You can partner with the trust for up to 80% of the value that's in the trust. And basically in partnering, you can use that money again for your business, whatever it may be. It needs to be a business purpose. Obviously, it can't be to go buy a Lamborghini or something, right? But yeah, you can use it to partner and then build wealth again on top of it with whatever business opportunity you have. Obviously, it needs to meet some basic financial investment opportunity goals, right? I mean, it can't, obviously you don't want it to be a losing transaction, right?
Yeah, let's give a real life scenario for this so everyone can bring this to life here. So I recently helped a client. They were selling a $13 million car wash in San Diego. They had bought land, about 2 acres for about $500,000, built on top of it $3.5 million worth of a car wash. And then they sold it for $13.5 million. So they're looking at a huge gain and about 40% of capital gains tax and depreciation recapture. Now there was 4 partners. One of them just wanted to pay the tax, so he was able to pay his tax. The other 3 used a deferred sales trust, a single trust for each of the family. So there's 3 total trusts, and they deferred the tax, took a promissory note back, paid off all of the debt, and they have been sitting on the sidelines waiting for opportunities because the real estate market, they believe, would shift. And sure enough, it's shifting as we speak. They fortunately got out about 1.5 years ago. Great timing for them.
Oh, yeah.
They sold probably at the peak or close to it. And they sold it in an environment where the buyer could still get relatively fixed, low rate financing. And they didn't do another 1031 because guess what? They're developers. They don't want to buy something equal or greater value at $13.5 million. They actually want to keep their cash liquid and to have no debt until the deals made sense. Now they're looking and they're getting really aggressive about buying because they believe in the next 12 months will be a key window, especially if rates stay high and investors are squeezed by higher interest rates that weren't fixed, or they were fixed and their rate caps have expired. And now they have a big debt problem and they're bleeding on their properties, even though the properties are performing well in the sense of occupancy and rent payments, but they might have challenges with insurance and rising expenses. But most of it, they have a debt problem, which has now has kind of poisoned the deal. And they are sitting waiting to invest into these funds, right? Into these opportunities. Mm-hmm. And that's the value of the deferred sales trust, that it can give you that time to make great decisions when it makes sense for you, rather than making, let's say, poor decisions or rush decisions via the 1031 exchange that ultimately don't solve what your maybe highest and best use as an investor is, which is building car washes, or in Rebecca's case, in her husband's case, building luxury or larger, cool Lake Tahoe truckee homes, vacation homes. So the deferred sales trust can partner with you to do other investments, can partner with you to buy more land, develop more car washes, partner with you to build a business. We're helping clients exit cryptocurrency and use those funds as the seed capital for the startup company. We did that for a $5 million exit for a client in California before the Bitcoin and Ethereum crash, although we're seeing that increase now, and we do feel we have a great opportunity to help a lot of people when the market comes back. That being said, I'm going to open it up for questions or thoughts. If you are with us live, you can put it into the chat. Any questions or thoughts that you might have as well. You are welcome to unmute yourself and say hello and ask a question or have a comment. We welcome all participants to participate. So I will give everyone who's on here a few seconds to do that. Otherwise, Rebecca and I will just keep talking about Lake Tahoe, amazing water that's just probably flowing like crazy from all the rain, right, Rebecca?
Oh, it is incredible. Yeah, the lakes are fuller than I've seen in 25 years. It's pretty amazing. And yeah, the water's still flowing. It's lovely to live here right now.
By the way, I'm living in Florida now, and the water here is warm, like compared to California. And it's funny. People are like, hey, we're going to these springs. And the people are like, oh my gosh, wear a wetsuit. And I'm like, wetsuit? I'm like, oh, that must be pretty cold. And we show up to these natural springs in Florida, and it's amazing. These waters just pouring out. It's 72 degrees. And I start laughing and I say, this isn't cold. What are these people talking about? That's as warm as California. I mean, compared to Lake Tahoe. Yeah, it's like it's a steam room, right? But right. Anyways, it's interesting. If you reach the Lake Tahoe water versus other water, I guess your temperature gauge kind of switches, right?
Right. Even someplace like Folsom Lake, down where you used to, live a little bit, there's that water is pretty warm, but 72, I don't think it gets much warmer than 72 there. So 72 is still really, really warm. But yeah.
If everyone gets to Florida, go to the natural springs. A really, really cool spot. Cool. All right. Well, I think it's just you and me, Rebecca, today. Let's see what other things that we could chat on here, or any questions that you have, Rebecca, or comments. Anything we just talked about. Yeah.
So Brett, you said that you were just at a conference that dealt with a family office. Can you define what a family office is for?
Great question. Yeah. So a family office is essentially, it could be a single family, it could be multiple families that are ultra high net worth, that are looking for more than just the traditional one financial advisor or one commercial real estate broker, but rather think of it like a mastermind on steroids that's focused all of its attention with that family or a couple families, and to grow the wealth in a way that is, estate planning, CPA, financial advising, commercial real estate, tax planning, and make it really seamless with professionals to help, as well as they come together, multiple families, and they partner together on different deals. And it helps to diversify the wealth, helps to maybe diversify the risk is a better way to think about it. Most of them tend to be very heavy in commercial real estate, very entrepreneurial in business. And so that is the definition of a family office.
Thank you. Thank you. I kind of gathered that from what you were saying, but thank you for adding that to my vocabulary. I appreciate that. It really makes a difference in the different levels of wealth and the people that you're dealing with and the education and knowledge that they may bring to the table that the average person like my husband and myself who have a financial advisor and have a CPA, but they may not be part of a team and we may not be pulling our wealth with other people. So
yeah, absolutely. And by the way, I also asked our good friend ChatGPT, and this is the way they define it. A family office is a private wealth management advisory firm that serves ultra high net worth investors. They're different from traditional wealth management shops in that they offer a total outsourced solution to managing the financial and investment side of a fluid individual or family. So in fact, if you go way back, like, the Rockefellers or the Vanguards, and they all have their family offices, right? Now they have like their single one typically, right? Mm-hmm. But they do tend to want to, connect with other ones. But in particular, family offices provide a series of kind of really tailored to meet the needs of those families. So there's like the ChatGPT provides a couple here. Investment management. The management of the investments align with the family's goals, risk tolerance, and financial needs. So it's more than just like a single couple. It's like, okay, this has grown so much that we want to look multiple generations, right? So this includes the management of traditional investments, but also direct investments in private companies, real estate, other alternative investments, tax planning and compliances, right? It moves into more of a tax flow game versus just a cash flow, right? I think at first, all of us who are building wealth, it's like, how do we get financial freedom by providing enough passive cash flow to meet our expenses and our living, our lifestyle, to unlock that time. Well, once you're ultra high net worth and you solve that, then it moves more into tax flow, right? Which is, how do we maximize, losses and tax efficiency, and staying within compliance of the rules that are, constantly in flux in times, right? And then you have estate planning, with asset protection, protecting the assets, protecting the family's wealth, with trusts and wills and other vehicles to ensure efficient transfer of the wealth for future generations. Then there's the philanthropy, like giving back, right? So they'll bring in, some of the best for charitable giving structures and helping the family to make an impact with the wealth, right? Rather than just wealth for themselves. It moves beyond just families' needs and wants and cool stuff, right? I think those are the main ones. And then I guess there's succession planning, right? Creating long-term financial plans that align with the family's values, goals, and intergenerational considerations. And so, yep, those are some of the main things that ChatGPT and I learned during this cool event.
Yeah, definitely sounds like it. You're definitely opening, I think all of us up to just thinking bigger and expanding our thought process about tax flow and wealth planning. And it's amazing.
Yeah, well, thank you. Yeah, that's the goal, right? And so, and I think that's a good thing for any business professional listening out here, is to be and shoot for all of us a goal of a thought leadership, and more of like a wealth. If you're in real estate, more of like a wealth advisor or a real estate investment advisor, rather than just sell real estate. Or if you're a financial advisor, it's more than just finance. This is also how can you be a thought leader in the entrepreneurial aspects of your clients' needs and wants and challenges, right? And so it's having that, I think, that breadth and depth of knowledge to really be that resource and that go-to person for your client. And the more you can provide value in those areas, the more likely you are to do more business, but because you're adding more value, right? Because you're touching on things that are challenges for those clients that you're seeking to help. So, by the way, if you want to learn more about any of this, you go to capitalgainstaxsolutions.com. You also check out the new book, Building a Capital Gains Tax Exit Plan. And we call it the proven playbook for unlocking your ideal wealth plan of any kind for yourself or your clients when selling assets. Need to be $1 million net proceeds, $1 million gain. but that is the book you can check out. If you want to learn more about Rebecca, you can go to RebeccaMunson.com. She can help you buy and sell real estate in Lake Tahoe and Truckee area. Rebecca, that's kind of it. I mean, maybe we wrap this thing up unless you have any other thoughts or questions.
I don't. Not today. Yeah, no, ready to get out there and enjoy being in Tahoe. So.
Absolutely. Enjoy the weather. It's I heard it's just perfect weather up there right now. I just got back from California a few weeks ago and it was pretty hot, but I heard it shifted down. And so it's pretty ideal. So enjoy the weather. Rebecca, thanks so much for being on and hanging out with me today. And everyone who's watching the replay, thank you. We hope this provided a ton of value for you. And remember, the 7 reasons family offices use the DST for their estate plan. If you're not a family office, you could still use all of these reasons for your planning as well. So we also want to encourage you, if you're selling any asset of any kind, to contact us. Go to capitalgainstaxsolutions.com. And we so appreciate everyone listening or watching out there.